continue to persist. Do you believe now that it's time that the government started moving? It's got an opportunity. The market for the last over a year was expecting RBI to move. It has moved. It surprised markets on the positive. But clearly now, the action now rests at Delhi and see what happens really there.
Yeah, I think, clearly the ball is in the government's court, and, they've been dilly-dallying with this issue for a fairly long time now. But I think there is a very clear need for the government to move away from these unsustainable fiscal support that they are providing to the economy, which is boosting consumption, but at the same time, I think is leading to a crowding out effect, a huge surge in government borrowing program, which is pressurizing interest rates at the at the longer duration of the rate curve. And this is really not good for the investment cycle. Obviously, there are other issues as well in terms of the policy-related bottlenecks that companies are facing on the infrastructure side in sectors like power, in a lot of the mineral-related sectors. So there are all these various issues, some of them policy implementation related, some of them policy creation related, and B, also this issue eventually of rebalancing the economy away from a unsustainable model of fiscally supported consumption, reducing the size of the government deficit, reducing the size of the government program, and therefore automatically making available far larger amount of resources either to the government itself or to the private sector to really get the investment cycle moving all over again. So that's really the large scale, dramatic rebalancing that they need to carry out. Unfortunately, from a political point of view, this is not a very easy, pill to swallow or administer to the people and to the, voters at this point of time. And we are now about 2 years away from the next election. There's only one more budget to go. So if there is an opportunity to act, the window is very small. It's in the run-up to the next budget, and therefore I hope that they will do it. But I'm not holding my breath as yet.
Vetri, if we go back to last year, one of the issues, of course, was what you just articulated, the whole policy paralysis here, our macros not looking very good. There, unfortunately, we're still pretty much where we were. There were global factors. Those seem to have receded quite significantly, as you've also noted in your last two reports. Oil suddenly came up over the last few weeks as a big, next hurdle, so to speak, as far as the market is concerned. Do you think that now it's really largely what we do domestically in terms of our ability as a government to push for reform, which is really now going to decide which way and which direction our markets move? Okay, I think we've... Vetri, if you could hear me?
Yeah, sorry, just repeat that.
Okay, no, my question was that last year we really saw a situation where there were global factors. There was, of course, the whole policy paralysis bit that you just articulated. That hasn't changed much. We're still pretty much where we were. The macros were one of the things that weighed on our markets last year, the domestic macros. Globally, things seem certainly better today than they were. Oil did pose a bit of a threat. Do you think it still remains a big threat because there are positive developments there as well? So would you say that the entire argument that you articulated right now about everything moving to domestic factors now is going to decide which way our markets move?
I think so. Eventually, Vivek, I think, the longer term trajectory of this market will be determined by how we get our own growth story correct. And unfortunately, what has happened in recent times is a lot of the pillars that have been supporting the entire growth story have, started to crumble or started to weaken a bit. The global factors obviously have been a dampening factor on growth ever since 2008, just as global support factors were extremely supportive during the 2003-2008 expansion. So I think we'll have to live with an environment in which the global macro, it may be slightly better than it was a few months ago, but in general, don't expect the global macro to be hugely supportive. Now, this really means two things. A, you should try to reduce or not depend too much on foreign inflows to support your growth. Yes, if they come in, wonderful. It will help us increase our, productive capacity within the economy and eventually allow us to grow much faster than we currently are. But we need to refocus on our ability to increase our domestic savings rate, increase the domestic investment rate, and that is what I think will eventually determine the outcome for this economy. There's a whole host of positives, whether it is the demographics, whether it is the fact that the government itself, even though the fiscal deficit is a bit out of control in terms of the government debt to GDP ratios, things are still not very worrying. The economy is growing at a rate which is much higher than the nominal rate of interest that the government is paying on its debt. So, that keeps a fundamental equation very favorable for the Indian economy. So there are a host of structural factors which are positive, but if you cannot capitalize on them, and that is where I think the biggest lost opportunity for India has happened in the last 2-3 years, is that we have not been able to capitalize on this. We have not been able to use this opportunity to say, how can we grow even faster? How can we put that productive capacity together? And I think eventually the outcome for India will depend on these domestic factors. The global factors will create a lot of noise, but the eventual outcomes for India will be a function of how we handle the local factors.
Considering, Vetri, that our markets have been largely driven in terms of fresh inflows from FIIs, given the fairly weak, if I may say so, inflows into our own mutual funds here or into our insurance companies who've seen a negative growth, in fact, given the reliance of that, and you made the point, the fact that global emerging markets are actually underperforming the developed markets today, do you think that that gush of money that we thought we would get simply because we are performing better compared to the rest of the world is pretty much a question mark now?
I think we will have to battle hard for our share. Nothing is a given in that sense. Just because you're growing at 7%, which looks better than the US, which is growing at 2 or 3%, doesn't mean that all the money is going to come rushing in over here. It's a whole host of factors. It's the kind of growth that you're able to produce. It's a function of the corporate governance that people experience. It's a question of the stability of the regime that they experience. I'm referring to issues such as the tax regime. So there are a whole host of issues which determine where money wants to go. It's not as simple as saying just because you're growing faster than the rest of the world, everybody's got to come and necessarily allocate their money over here. It's also a function of the quality of the growth that you experience. So I think, the point that I would make is, again, if you break this down into simple arguments, why would the domestic investor be incentivized to invest in equity when he's able to get double-digit rates of returns on his bank deposits, when you can invest in tax-free bonds issued by Government of India, which give you a post-tax yield of 12%? I mean, there is no incentive for them to go out and buy equity, and that's the unfortunate truth. So, if you can get inflation under control, if you can get interest rates back down to a far more reasonable level, there will be a natural inclination on the part of the retail investor in India to allocate more money towards equities. Today you aren't providing that environment to them. So it's pointless to just focus on the growth fixation and the market performance bit without realizing that the underlying fundamentals and the rates of interest which are being offered to investors are not incentivizing them to look at equity. And I think as far as the foreign investors are concerned, we will certainly have to do a lot right to attract their capital, whether it be through FDI, whether it be through FI inflows. But believe me, if you've got a domestic market which is naturally inclined towards buying equity and you get the virtuous cycle going, I think they will see every reason to allocate incremental amounts of capital, presuming everything else in terms of the stability of the regime is something that they are positively inclined towards.
How significant do you think, Vetri, is the China factor going to be? You do make a mention in your recent report that growth is now clearly flagging, and just as in India, there are hopes that policy in China will turn more supportive this year. How seriously would you look at that as an issue?
I think as far as China is concerned, if you look at their GDP data, it's still very healthy. But if you look at the high frequency data, and that's what we've been hearing about from a lot of strategists and economists, their economy is also going through a fairly tough patch, because if you look at data like power production, cement production, there are signs of stress in that economy as well. Having said that, I think, really the Chinese economy is a little bit of the opposite of the Indian economy in the sense that it has very high investment growth rates, and frankly, those might not be sustainable going ahead. So I think the big picture for me from that would essentially be that eventually if China just slow down, and even if you see some kind of policy response, it's highly unlikely that China will ever achieve the kind of investment rates that it did during the last decade. Let's say in the foreseeable next 5 years or 10 years, the investment rate will have to come down. To some extent, I think that is sort of positive for India, simply because it will reduce the source of large demand that we have seen for commodities in recent years, which has been driven entirely by China. Because as far as India is concerned, we are a net buyer of commodities, particularly of oil, and therefore any sort of reduction in growth rates globally at some extent I think is marginally more positive, though mind you, from a corporate earnings perspective, it's a slightly more tricky equation because we have a lot of large commodity companies which make up a significant part of the Sensex. So if you just ignore the earnings perspective in general, I would submit that a easier commodity price regime at this point of time is something that would be a little bit favorable for India.
So directionally, how do you see this market going? From what I hear from you, Vetri, the issues that are concerning you are not likely to go away anytime soon. It's not like tomorrow we're going to get our act together and the government's going to start moving. Given that, over the next 6 to 12 month kind of a time frame, the trajectory I'm not asking for levels, but the trajectory, how do you see this market moving? I don't see you sounding very bullish.
Well, it's a bit hard to, stay bullish in the face of all the kind of macro news and the inaction that we are currently seeing. But I'll just put this in two perspectives, right? Because this is important to keep in mind. First is valuations. As far as valuations are concerned, valuations are very much in the comfort zone. In fact, valuations are much cheaper than average. If you look at our 10-year, 15-year history of, average PE multiples, we are anywhere between 5 to 7% cheaper than that. So valuations are not really in the risk zone. So from that point of view, I think, that's one issue that we don't have to worry too much about. But yes, macro remains a significant challenge. And at the same time, I think macro is something right now which is there are so many different factors feeding into it that frankly the call that we've taken is that beyond a point it's not possible to figure out right now which way the macro is actually going to move and which sectors might be hurt more or less, and therefore we've shifted our focus to saying what's far more important today is to get your company selection right, because what you want to do is make sure that you're invested in companies which A, can handle these challenging environment that we are currently going through, and B, as and when the environment starts to improve, these will be the companies that will actually start to benefit from any upturn in growth. So really we've shifted away from worrying too much about the macro, partly because, how much can you go on worrying about it, and partly because it's getting very hard to figure out who is actually suffering more than the other, and shifted our focus to saying therefore just back the companies that will, come out of this troubled environment, like they are all set to run a 100-meter dash, and, these are companies that are marathon runners. So that's really been our focus, more company specific rather than trying to guess which way the economy is headed, which way the global macro is headed, and which way the market is headed. And if you look at actually what's been happening in the market, I would say pretty much over the last 12 or 18 months, actually stock picking has played a far bigger role in determining the kind of alpha that you've been able to produce than just trying to read the macro trend. So I think that's really the approach that we would take. And as I've started my comments, valuations at this point are telling you that they are supportive, they are very much in the comfort zone, they are cheaper than average. So really, can you afford to get too bearish based on macro? You can't, because your valuations are actually below average.
So my next question therefore, are you saying that you and your fund managers are able to find enough such good stock picks even at this point of time at these levels?
I think so. There are a fairly large number of companies which have, cleaned up their act over the last few years. They've got their balance sheets in place. They're generating cash flow in a big way. They've invested and prepared themselves for whenever you see the investment cycle start to turn up again. And in many cases, these companies have derated over the last few years, and certainly derated very significantly from the kind of valuations that they enjoyed way back in 2007, 2008. So incrementally, we are starting to allocate a lot more money into these companies, but our primary sort of flag over there is the health of the balance sheet and the strength of the cash flows, because where we do not want to go is into companies which are financially vulnerable at this point of time, because that is the kind of risk that is unacceptable to us given the current macro environment. So that's really been the broad principle. We've been hugely positive the domestic consumption theme for a while now, but frankly at these valuations it's getting almost impossible to allocate any further money into it. In fact, we've been taking money off the domestic consumption space, I think now for the last 6 or 12 months, the stocks have continued to run up. We haven't still gone underweight on that area. We would do that only if we saw the great rebalancing act being pulled off by Government of India. But we're still marginally overweight, but still sort of more attuned to booking profits in that space rather than continuing to stay overexposed there.
I know we don't talk stock specifics, Vetri, but which would be the thematic sectors within which a larger part of these good companies that you've picked up, which you are mentioning, would be lying? I'm not trying to take a sectoral call here because you yourself made the point that it's more a stock-specific thing, but just to get a little more clarity, like you made the point on the domestic consumption theme, would there be 2 or 3 themes within which a bulk of these stocks would be lying?
Actually not, Vic. They're actually spread out across sectors. We have incrementally, of course, a lot of these companies that I talked about are essentially companies which are in 2 areas which we are actually underweight, which is in the industrial area and the banking area. But incrementally over there, we are able to find companies where we think the valuation derating is now quite significant. The companies are stable. The balance sheets are, reasonably protective of value, and therefore incrementally we've been doing a lot of this buying in the banking and industrial space. But as I said, we've still not really gone overweight those areas because we really have very poor visibility as far as those 2 areas are concerned. If you keep crunching down sectors, you will find areas or pockets where things look interesting. So within the material space, a more domestic driven area like cement has done reasonably well, and there have been reasonable values over there, maybe not today, but at least about 6 months ago. Similarly, if you look within the whole domestic consumption space, I think in some cases within the automobile space there was a significant derating, and that was an opportunity. So I think unfortunately this is the kind of market where easy answers are not going to come by, and you need to do a lot more hard work to figure out within sectors, within sub-themes, where are the opportunities for actual alpha generation.
We'll leave it there. Thank you very much, Vetri. Like always, a pleasure talking to you. Thanks for talking to our viewers. All right, that was Vetri Subramaniam of Religare Mutual Fund. We take a quick break here on Market Guru. Come back with lots more action coming up on Bloomberg UTV.
In association with Expedia, world's largest online travel company.
64,000 crores total debt sought to be restructured in fiscal 12. Is India Inc. on the verge of a debt crisis?
NPLs will be between 25 and 50% depending upon how the economy plays out over the period of time.
Indicator of 15 to 20% of CDRs would become NPA. I do not subscribe to that view. According to me, all restructured standard loans are really NPAs.
CDR has increased very substantially, there is no doubt about that, and it does represent stress in the system.
Every Android bot wants to be blue because blue bots on Reliance enjoy Google mobile services on the fastest 3G with 1 GB data free. Be blue, it's simply better.
Reliance. If you're a first-time investor, frightened about that first move, planning for good old 40s, aiming to keep failures away, worried about those hard-earned savings, and puzzled about your choices, it's time to meet our experts, the Financial Planner, presented by BSE, Investors Protection Fund.
Presented by Sensex, India's index the world tracks. BSE Investors Protection Fund.
Currency volatility is a given.
News continues to be bad, whether it is Europe or other markets.
We've seen healthy increase in our profits.
We are very happy that Africa is offering a stable performance.
While of course we have to look at costs.
We are keeping a close watch on the commodity.
Catch the biggest corporate talking about their earnings throughout this month. Only on Bloomberg UTV.
I see you and I begin to slide, losing my mind under sapphire sky. If I just had you.
You've never seen anything like it before. The all-new Sonata.
Foremost reason for Titan's early success is the path we chose. I think we were there at the right place at the right time. We made things happen. We didn't choose to topple HMTers. I think they fell by themselves. It's every day make or buy at Titan.
The lower the market goes, it becomes a safer place to invest.
The Nifty is pretty close to the 5,000 mark.
That's what the flavor of the market is today.
Banking and capital goods are the most attractive sectors to play.
It is completely an out-and-out traders market.
Countdown, presented by BSE, Investors Protection Fund.
Presented by Sensex, India's index the world tracks, BSE Investors Protection Fund and Tourism Australia.
एक बात समझ लो, डॉन को पकड़ना मुश्किल ही नहीं, नामुमकिन है.
Silence, please. Business aspect, I understand it. It helps me to make the movies.
Your film becomes a brand because people take to it in a certain way.
For a creative producer, it takes a lot of heart. In my creative decisions, I am not thinking about box office.
Hello and welcome. I'm Savina Rani and this is News Express. In an exclusive conversation with Bloomberg UTV, RBI Governor D. Subramaniam says the rate cut alone won't spur growth and that the government too needs to do its bit. Adds that more rate cuts will happen only if strong supply-side action is seen. 2 days after the RBI cut repo rates by 50 basis points, state-run lender PNB said it will cut its base rate by 25 basis points to 10.5%, effective 1st of May. In the meanwhile, IDBI too had passed on the benefit to its customers by cutting its rates by 25 basis points last evening. The weakness in the rupee continues on Mint Street. The currency is inching closer at 52 against the dollar mark. This is the lowest level traded on the currency since the 10th of Jan. The cement space is in focus today as majors ACC and Ambuja Cements are expected to declare earnings. Net sales for ACC are seen up 19%, while Ambuja is expected to report a growth in sales of about 24% to 2,727 crores. India today tests fired for the first time its most ambitious strategic missile, the over 5,000-kilometer range Agni-V, in a bid to join the super-exclusive intercontinental ballistic missile club that counts just the US, Russia, China, France and the UK as its members. The solid-fueled Agni-5, which will bring the whole of China as well as other regions under its strike envelope, was tested from Wheeler Island of the Odisha coast at around 8 a.m. this morning. Hello and welcome. You are watching Market Pulse and those were the big headlines that we're tracking this morning. A quick check of the markets and it's looking a little uncertain, a little edgy if I can call it that. Very flat on the street. 5,300 is where the Nifty trades at. The breadth of the market's also not looking very convincing and sectorally speaking, barring of course the auto and the healthcare pack, all other sectors are trading with a negative bias. Losses though are being led by the power space. Cap puts are looking weak too. The oil and gas pack is looking a little weak. In banking as well is seeing some amount of profit booking after yesterday's gains. In terms of the big big movers and shakers. Tata Motors tops that list once again. So another 2% has been added on that counter. 315 rupees, or rather 316 rupees is what it trades at now. Tata Power not too far behind, nearly 2% up on that one. Ranbaxy, Cipla, Dr. Reddy's and Sun Pharma are amongst the top gainers on the Nifty. Maruti is doing quite well too, and Coal India is also holding on to its gains. Infosys, after its recent sell-off, is marginally positive this morning, up nearly 1%. On the downside, it's ADAG stocks that are coming under pressure. A couple of those banking names are not looking good either. ITC as well is looking fairly subdued in trade. In the mid-cap space, it's IGL that's selling off quite sharply. That counter, of course, looking weak ahead of that hearing that was expected in the Supreme Court at 10 a.m. Not sure what the outcome of that is just yet, but remember the stock did open up positive, but has sold off in the last couple of minutes. Recovered from its day's low, but still looking quite weak, 2.5% lower on IGL. GVK is the other one that's down 3%. IVRCL is down 3% as well. Kingfisher Airlines is trading about 3% lower. On the gaining side, you've got SJVN that looks good, so that stock is actually holding on to it. Tata Motors DVR, that one's up about 4.5%. So that counter pretty much outperforming its Tata Motors peer back here. So that's the picture. It's not too exciting. A little bit of sort of weakness and back and forth from positive to negative territory is what we're seeing in today's trade. Well, moving on from the equity markets to what's happening in the currency space, the rupee continues its slide, in fact trading at a 3-month low against the dollar, inching closer to that 52 mark against the dollar. Well, it was Vetri Subramaniam who had an exclusive conversation with Bloomberg UTV's Vivek Low and Minister Mal Bandyopadhyay, and said that this currency volatility is normal, as the current account deficit is likely to actually remain quite high.
You know, one of the biggest concerns that you've had to grapple with, the corporate India has had to grapple with, has been the currency. And just to take on from the point, and I know that it's occupied a lot of your time and your effort as the governor, you've also talked about in your statement, in the policy statement, that with global capital flows to emerging markets projected at lower levels in 2012, this entire current account deficit continues to pose a challenge to you. What's the medicine there, sir, according to you?
For redressing concerns on the current account deficit?
And more specifically on the currency, on the inflows.
Well, you know, they're interconnected issues, but let me also try and address them. First, on the current account deficit, yes, it's been high and it's projected to be high this year. Current account deficit has been high because exports have moderated. Imports have gone up on the back of oil prices and gold. So our action yesterday, I believe, would to some extent restore inflation expectations and therefore reduce the appetite for gold. As far as oil is concerned, we have strongly exhorted adjustment of oil prices, which should, if not immediately, but at any rate in the short to medium term, have an impact on the demand for oil. So I believe that while there cannot be a short-term overnight fix to current account deficit, we need to be taking measures from now on so as to make it, bring it back within acceptable levels. On the second part of your question about currency, of course, it's moved rather markedly since mid-August, of August 4 to be more precise, when the US debt downgrade took place. But we have intervened in the market in conformity, I believe in complete conformity with our policy, which is to smoothen out volatility and to prevent disruptions to macroeconomic stability. Otherwise, our policy continues to be that the exchange rate must be market determined. There are, of course, people who benefit, who gain, and people who lose, both from depreciation and appreciation of the currency. But just one final answer to your question on the exchange rate itself. You know, if you take the 36 currency real effective exchange rate, that used to be overvalued, that's near its base level now, which shows that the currency has found its level.
Doesn't give you sleepless nights anymore?
Well, both the Reserve Bank as an institution and we keep concerned about the inflation, our exchange rate. And that's also because, you know, the exchange rate moves for reasons beyond our control. If something happens about the Spanish debt auction, that has an impact on our exchange rate, so we have to be on constant vigil.
Well, just taking a cue from that conversation, it's the rupee that's under tremendous pressure. Let's quickly pull up the dollar rupee chart to see what's going. 51.86, so it's of course eased off from the lows of the day, but still not looking very convincing on the dollar rupee. Diana is standing by to tell us what's going wrong with the currency, if I can call it that. Diana, the slide continues and it's looking extremely volatile as well, inching closer to 52.
That is right. In fact, we touched low of 51.95 in intraday. This is in opening trade. So really, pressure keeps coming on the rupee, and in fact, you cannot really rule out any kind of intervention by the Reserve Bank, because if you look since September up till now, you've had intervention of almost around $20 billion as far as the forex market is concerned. The RBI was seeing buying dollars during heavily during the months of December